Hey, what's up, everybody? Kris Bertinoli.
Landon Kesler.
I'm with Legacy Ranch Properties. This guy,
I'm with Idaho First Mortgage.
yeah. So Landon and I were talking a couple weeks ago, and we thought, man, let's get together and just talk a little bit about some of the nuances of our industry.
Yeah.
Let's talk about some of the most common questions we get asked, and maybe some of the most common myths that exist out there in the world of real estate.
Yeah.
So,
Love it.
Landon and I were talking. There's a lot of buzz right now, and we're going to kind of keep this generic, but about interest rates. So I just said to Landon, most people don't know how this works,
Yeah.
brother, and he was teaching me a few things. So, Landon, give me an overall, like, high level view of how interest rates work and how they're affected.
Yeah. Mortgage interest rates, hot topic. We had a time where interest rates got to levels that I thought I would never see in my career. I mean, we're talking rates with a one in front of them.
Insane.
It was incredible. And
That's free money.
it was free money and people used it. And I would guess if you had a mortgage during this time frame, you refinanced in 99 there was probably a few that had their head in the sand, but 95 to 99% of people with mortgages were able to refinance or purchase with a rate between 1.5 to 3.5.
It's in-
Just incredibly low interest rates.
Nobody should have over an 8 interest rate right now.
Yeah, you should not see anything. Well, the problem with that is rates, because of runaway inflation and the role of the Federal Reserve, they kept rates probably too low for too long,
Mm-hmm.
and then they had to increase rates.
Yep.
And I can't tell you the exact time frame where rates started to creep up, but now we've seen this pretty long time frame of elevated interest rates to try to bring inflation down. That's one of the tools in the Federal Reserve toolbox to tame inflation, is to raise interest rates.
So let's talk about that. That's what they're looking at. So when people are like, "Oh, are they going to lower the rate? Are they going to increase the rate?" What are the key things that they're looking at when they're considering that?
So the Federal Reserve has a dual mandate.
Okay.
Their dual mandate is to try to keep inflation at 2% a year, as close as they possibly can. If it gets under that, they got to do some things to
They
try
gotta
to
move
get it
some
back
things.
up, because 2% inflation is healthy inflation. And the second mandate is full employment. So their job is to try to keep the economy moving, keep people employed, keep the unemployment rate low. And that's a balancing act. And so, with the biggest news maker of inflation being, it was 8, 9, 10% during COVID. The government was printing money like crazy,
Mm-hmm.
free handouts for everybody to try to get through something that no one had ever seen before. And inflation just got out of control. And so, yes, the Federal Reserve, as one of their tools, had to raise rates to try to bring inflation down. And then, of course, we've had really great employment. And so if we have low unemployment rates and inflation still at elevated levels, they got to keep interest rates high.
And that's kind of what we've seen for maybe the last year, right?
Yeah, 2 years probably now that rates have been, they call them
Steady.
at restrictive levels is the term they use. We're restricting the flow of money.
Right.
And that's really what their job is to try to restrict the flow of money to keep, I guess, consumers and businesses from spending too much. Because if it's cheap to borrow, we're going to borrow what we
Yeah,
can.
we're going to take it.
And we're going to go build businesses and buy houses and real estate and really spur the economy going forward.
And the challenge is now the other side of that is if they're restricting, right? We've got restrictive rates. Normally, you would see unemployment start to edge up.
Yes. And that's what we're starting to see. We're starting to see some weakness in employment. And so now the Federal Reserve is feeling some of the pressure. Not only are they feeling pressure from the, administrative president of the United States, but they're feeling pressure from the employment sector as well. They're starting to see weakness, not as many jobs created, a lot of jobs lost. You're seeing jobless claims increase. And so now they're still feeling pressure. We've got to do something. And so we're seeing sporadic rate cuts.
Mm-hmm.
And so those make a lot of headlines. Rate cuts make a lot of headlines. And I know what your follow-up question is so what does that mean
Yeah, exactly.
for the consumer
Exactly.
when
If
the
I'm the
Fed's
guy out there saying, "Oh, I just read this headline," like, "Hey, the Fed just cut rates,"
Yeah,
like, you and I talked about this, you're reading that headline, you're too late.
you are too late, and here's why. Federal Reserve interest rate decisions do not directly impact mortgage rates or interest rates that we as consumers get to borrow things at. Auto loans, mortgage loans, RV, all that stuff. So what they do though is they're setting the rate at which banks can borrow from them.
Mhm.
So if banks can borrow from the Federal Reserve at a lower rate, then they can in turn loan money to the
Pass it
end
along.
consumer at a lower rate. But it takes a minute to get there. Well, what people don't understand is the market, the 10-year bond or the mortgage-backed security market is always trying to anticipate what they think the Feds will do. They're also watching inflation reports. They're also watching employment reports. And when those reports come out, the market will react to the report because that will in turn influence what the Fed does the next time they meet. So, heading into a meeting, the market's thinking, oh, the Feds are probably going to cut rates by 0.25%. As a result, we see interest rates on mortgages lower
Drop.
by about 0.25%. And that's what we've seen. And we see it time and time again. And it happens the other direction too. But then when the Feds actually do the rate cutting the day of, sometimes you'll see the opposite happen. And why do we see the opposite happen? Because we'll get notes from the meeting or we'll get the dot plot, which is their projections for future rate cuts, and that will tell a different story. And so now all of a sudden the rate market turns and goes the other direction. So when a borrower calls me and says, "Hey, Landon, I heard rates drop by 0.25%. I can't wait to get that 5.75 instead of 6%." And I have to tell them like, "No, it's still at 6% because the market had already come down in
Yep, reacted.
anticipation of
Yeah.
that." So,
It's interesting, and I think that, so for me, as I'm talking to buyers out there that are looking for homes, one of the biggest challenges right now is this: I'm going to wait. I'm going to wait until interest rates drop. And so, what we just talked about, I think, is something that people need to understand: is the markets react
mhm.
far in advance, week maybe
Yeah,
in advance of the Federal Reserve making their announcement, and then however that's received in that meeting, if it's positive messaging that's like, yeah, we're going to continue to kind of move this direction, or if it's, this is garbage or whatever,
yeah,
which is kind of what we've seen from
yeah,
some people playing politics,
yeah.
then there's a reaction. And that's why we've even seen, like, hey, the Fed just reduced the rate, but the rate increased,
Right,
right?
right.
As a reaction. So, okay, so now let's talk about these buyers that are, in this market. A lot of buyers they're kind of struggling right now trying to figure out, what do I do? Affordability is really a challenge. We're seeing below 500,000 is kind of where people are still able to buy, but that's even challenging some people.
Yeah, affordability is the biggest thing, and when someone calls me and says, "I need to get pre-approved for a mortgage," I have 2 main goals with that discussion is, okay, let's find your ceiling based on
Mhm.
your income, what you can document as your qualifying mortgage income. Let's find out what your buying power really is and give you a ceiling. Well, then I'm gonna tell you what your mortgage payment is at that ceiling, and you're
Mm,
probably not gonna feel very
right.
comfortable.
Yep.
Right? Interest rates at a higher level, and a lot of unfortunately, a lot of buyers get discouraged at that point.
Mm.
"Oh my gosh, I can't buy a home in that price range. I just can't fit that into my current budget." And then we have to say, "Okay, what are you comfortable with? Let's back that mortgage payment into a home price." And
Mhm.
once again, they get really discouraged. "Oh my gosh, that's only
Yeah,
250,000
that
or
only
that's
gets
only
me this.
300,000 and look at what's on the market at
Yeah.
300,000." And then they kinda just because of that discouragement, they sit on the sideline waiting
Mhm.
for interest rates to come down, and unfortunately, by waiting, what happens when people wait for
Mm.
rates to come down?
Yeah, it just creates mass hysteria when they finally do, and they miss their opportunity. We see hyper competitive markets that are multiple offers, and so, what's really interesting about that is the minute that starts happening, Landon, values increase. It's supply and demand. It's the law of economics, and so even the prices that exist right now, if the rates do come down, you're going to be competing with more people. It opens the buyer pool.
Yeah, I have this conversation with people that come to me with maybe a pre-build. They've gotten with one of our mass local builders, and they got a home under contract that won't be completed until maybe December, January,
Mhm.
February of next year. They've locked in a price. What they haven't locked in yet
Is a
is an
rate.
interest rate.
Yeah.
So I tell them, like, gosh, you are in such a great place because you have just locked in that builder's price based on current market conditions. But next year, hopefully, rates, maybe they're down a quarter, 0.5%, 0.75%. The impact that will have on their overall payment is going to be huge. And I'm not saying run out there and go get a home under contract with one of our builders. I'm just saying now is a great time and maybe a small window of opportunity where you can get some seller concessions, some builder concessions, maybe get a
Mhm.
little bit of those upgrades in your home, or a little bit more square footage, get that third car garage. Because if you wait till February, March of next year when rates come down, and now you're buying a home that was 400 for 430,
Yep,
because the
exactly.
builders will have to increase prices based on demand.
Yep,
Yeah.
exactly. Exactly. And, one of the cool things, and I know you guys do this as well, is I just call it a boomerang. If you can get into the house right now at 400
Mhm.
in the example you just used, and you're at a little higher interest rate, but rates do come down, well, you can boomerang back, refi into that lower rate. You guys have a no fee refi where you help them out a little bit with the fees. And so it's kind of the best of both worlds, right? I get into the house and you talked about a $30,000 differential there. Maybe it's more, maybe it's less, whatever it is, but the cost to refi is not going to be nearly what that difference is going to be.
Yeah, even if you take 5% appreciation, I've done this exercise and I'm not going to pretend to remember all the numbers, but just if a home appreciates at 5%, the difference between the interest rate and that 5% appreciation is massive,
It's
right?
huge.
And so the exercise is this. If I buy a home today at 400,000 and then I refi a year or two later and the appraised value comes in at 430, 450, now I've got this equity that can help me lower my interest rate, maybe my mortgage insurance premium, maybe I can drop mortgage insurance at that
Hmm.
point. So it can really make things a lot more affordable. And I'm not saying this to talk anyone into doing something that's going to put their family in
Pickle.
financial
No.
distress.
Yeah,
We
you
don't
don't want
want
to do
that.
that.
But if it's a little bit uncomfortable, maybe you don't buy the Starbucks or Dutch Bros every day. Maybe you cut out the subscriptions a little bit and just, bite the bullet. It's really gonna pay off.
Cut the Netflix? You saying cut the
I
Netflix?
just got Netflix and I'm
Okay.
enjoying it. So I don't know if no. Yeah, cut the Netflix, man. We don't
Uh,
need to spend that
the
30
Big
bucks a
Mac.
month. Yeah.
Yeah. Well, and I would agree. 100% of the time, especially if somebody's renting.
Yeah.
I mean, that's where I just get sick to my stomach because, by doing that, and all the investors out there, you're going to hate when I say this. Renters are part of the economy, but if you have the ability to buy, because by renting, you're not taking advantage of any of that appreciated value that you just talked about. The minute you buy, you start to get to play in that appreciation, and that's how you build equity
It's how
and
you
wealth.
build wealth. Yeah.
That's
I mean,
right.
think about rent. Okay, yeah, my mortgage payment's gonna be $500 more a month or $1,000 more a month. So over a year's time frame, I paid $12,000 more out of my pocket to own a home.
That's right.
Well, guess what? You just more than covered that with appreciation, and you were paying down your own mortgage.
That's
You're
right.
creating this wealth gap, and it's going to put you on a stepping stone to continue to just expand your real estate portfolio. You're going to build equity, sell, buy another place,
That's right.
and then over time, you look back, man. Yeah, I'm way further ahead than I would have been had I just rented.
We're going to do a whole podcast about that. You and I will talk about, that buy one, flip it with the equity,
Yeah,
not flip the property, use the equity, buy another one. We'll
love it.
talk about that. Yeah, let's wrap this thing up. We don't want these to go too long. So I would just say key summaries for this little chat that Landon and I have just had. If you're a buyer out there, go talk to a lender. Call Landon, call his team. They're amazing. Put a plan together. You need to know where you're at right now. They're going to tell you what your selling is. They're going to tell you what your options are. But then at least you know. Number two, don't be afraid to enter the market right
Yeah.
now. Interest rates should not be scaring you. Over time, they're going to flex, they're going to adjust, they're going to do some different things. We try to read those, the Fed
Oh
and
yeah.
the markets try to read those, but at the end of the day, the best thing to do is to be in the game and playing. So
I agree, and I think getting with good professionals that can help advise you that will always put your interest before their own
mm,
is critical. No one should ever put any unneeded pressure on somebody to get in. Just get the information, be
That's right.
educated, know where you're at, so that you can make good, solid educational decisions, and you'll be headed in the great direction.
Awesome.
All right.
Okay, we'll do
Thanks,
this
buddy.
again, man. Thanks for
Appreciate it.
coming, Landon.